All right, welcome back, everybody. This is Alex and Drew talking about mortgage financing. We come to you every Monday, try to give information about mortgage financing. This week, we're going to talk about construction loans, and sort of one of the things Alex wanted to mention this is what we call hard money, or money that's not necessarily from a bank that's can provide opportunities. And as part of this, and talk about closing that would be the impossible construction loan. But we also do just general construction financing, and we're going to talk about all that in this little quick episode today. Well, if you enjoy listening to it, there is a like button down below if you want to check all that kind of good stuff for us. We'd appreciate it. First, just let me say that I really like construction lending. Probably Alex thinks I'm a little addicted to it. It's just something that I have always enjoyed doing. And the reason I think I like it more than anything else is when I got into banking with actually what is today Bank of America, I was a commercial bank loan officer, and I did construction loans for mortgage people like myself today. As in today, even, mortgage lenders generally do not offer construction financing. They only do 30-year fixed rate mortgages or other type of mortgage programs. But construction financing is this oddball program where it has a short period and no amortization. It requires draws and disbursements, and the administrative cost of it, mortgage companies, just generally speaking, don't like it.
Well, why don't they like it, Drew? Just why does a mortgage company or a bank be like Wells Fargo, Chase, or common bigger banks, Bank of America? They don't have a construction loan product at all. Zero, none. They don't offer one.
Right.
And,
well,
why don't they like it?
The big banks don't like it because it's not a homogenized product. Markets treat this differently. It is more popular in certain markets. And honestly, they see it as higher risk because there is the chance the house doesn't get built and default. And there is a higher risk perceived in the industry. I think it's a misperception, not one that I was really aware of when I first got in the industry, being a youngster at that time. But there is a risk of default that's higher than a regular house because of cost overruns and things of that nature. And the second reason they don't like it is if you make a mortgage, you get potentially 2 or 3 times the actual loan amount. If you bought, let's use a simple number, $300,000 over a 30-year period on a 6% rate, the bank's earning $600,000 or $500,000 in interest, double what the actual principal amount is. On these loans, they don't really earn much interest because they're 12 months. That's
my main point.
That's why they really like them.
Yeah, exactly. They really don't make great money while you build the home. The bank's oh my God, I want that loan because you're building a house. They're like, oh my God, I don't want that deal because it's not very profitable. It's not very profitable.
The amount of profit is small. Margin might be high, but amount of profit small. And, almost any bank that makes a construction loan, independent as a closed construction perm loan that would do that, would charge a fee of 1 or 2% to even make it remotely profitable.
Yeah. So a lot of lenders locally charge 1% of the loan amount for just one of the closing cost fees. So if your loan amount is $500,000, it's very common that most lenders on the Outer Banks charge a $5,000 fee just as one of the closing cost fees. And then you have all the other closing costs on top of that. So that's because they don't make a lot of money during the build. The lender doesn't make a lot of money during the build. They want to get some money up front in that closing cost.
Right. But the reason I liked it so much back then, just so everybody knows why I got so enamored with this product and doing so much of it, was one, there wasn't anybody doing it for the mortgage lenders. So I was like a single source. So I became a volume source. So that became more profitable. We were brand new on the Outer Banks at Nations Bank at the time. We had no branches, no customers, no deposits, and no loans. We needed loans. We could charge a fee of 1%. And so we created instant fee income. So I became almost immediately like the celebrity construction lending guru guy to go to because we were like hungry for this type of business. And it really gave me a first row seat, as I call it, to mortgage lending, because then I realized what do mortgage lenders do that are different than bankers, and why would I be a mortgage lender versus a banker? And I came to the conclusion that, hey, if you could do something better for the client on a construction perm basis, which I was already doing already, and I was learning sort of mortgage underwriting as part of it, maybe I could actually make more money and be more successful. and provide for my family better if I was a mortgage banker as opposed to a banker that you walk in and meet and sit down. So just being a specialist doing mortgage financing is basically what a mortgage originator does, as opposed to doing all kinds of banking activity, houses, as well as maybe commercial, residential, even maybe car loans in a bank branch. And so, not to mention, there's a lot more politics and bureaucracy involved in being a quote banker, as opposed to us basically salespeople. We're looking at salespeople and being more lean and meaning, sort of like running your own shop. And I found that customers and builders are very loyal groups of people when you help them through a process that's difficult. And I also found that mortgage lenders as a whole, because of this profitability issue, because they don't get paid for some of these loans until the permit is in place, they sort of run from them. Mortgage lenders as a whole,
the typical mortgage lender doesn't like them.
They're like,
they don't like them.
You want to construct your loan? We got somebody that does that. I don't do that, and they just don't even want to talk about it, even if it's a $500 or $1 million or even $2 million loan amount. Or if you start kind of talking to them, I think the customer can quickly discern that they really don't know very much about how the draws are done or what interest they might really pay.
It's very intimidating.
It's complicated.
It's an intimidating process.
The second part is they're messy. Things do go wrong. People get pissed off each other. Houses catch on fire while they're being built. Things like that have happened to us. We've worked through all these issues with no problems with our clients at the end of the day, but there are problems that occur. And you have one of those two happen with most loan officers, and they're like never again. And I've always just like not going to treat it like never again when I have that situation. So again, that's another reasons I like them. So what does First Heritage offer? We have, as a mortgage company, an independent mortgage company, very rare, especially an independent mortgage company of our size, which is we're not a big Bank of America styled big company. We have what I consider some of the best choices I've ever been offered, and I'm glad to have what we got. So what do we have? We have a one-time closed construction perm program that is very attractive in the sense that it's one closing. It has the low, very, very low cost. The reason it has these low costs is that when we're financing primary residences, and this is a primary residence design pricing product I'm talking about at the moment, is we give you a credit towards closing costs instead of actually charging you a 1% or a half a point or any fee whatsoever. Now, in my example in the handout that you can read today, if you want to, you can see there's an $800,000 example. And with an $800,000 example, even with this loan that has no points, you still have closing costs that are pretty close to $7,000. Okay, the actual number I used in this is $6,525. $800,000 loan amount. This loan gives you a credit. The credit is based on the loan amount of $800,000 or a half a point. 1 point would be at the 8,000. A half a point would be 4,000. Okay.
I think an easier way to put it, there's a lender credit that pays for a lot of the closing costs, is essentially what he's saying.
Yeah,
there's a lender credit.
$4,000 in this example.
Yeah.
And your closing costs were roughly $6,500. And so you got $2,500 invested in this mortgage.
Yeah,
so
slow.
Why do I like it? Because you've got one closing. You've got a mortgage at the end. You don't have to do anything at the end. You're done. You got a 30-year term when the house is finished. You can refinance it the day you get finished if rates are lower. There's no prepayment penalty. You have really nothing invested in this mortgage except $2,500. Most lenders are going to be $7,000 roughly to close the mortgage. You don't have that investment. You've saved it, so to speak, for when you really want to get the best rate you can. This is not the lowest possible rate program in the world. This is the lowest possible closing cost program in the world. And so you've saved it to get the lowest possible rate from us if we can refinance it for you and you like what we've done for you before and we've given you good advice. Or you can go anywhere and get another mortgage from somebody else and get a lower rate. Again, you can pay it off the day after the house is finished, and it's really a great program. And you can read about that in our handout. So do you want to say really about that option, Alex?
It's really just a great way to have a low amount of closing costs, build the home, and then especially in the past 12 months to I'm sure in the future too, I would even say maybe 16 or 18 months, rates have been trending downwards. And as people complete their homes, like Drew's saying, you can just refinance it and you haven't really paid a lot of closing costs in general because the first loan you pay very little, like you just described. And then the second loan, when you refinance it, you're going to get better terms, usually have more equity. And usually you might have a lot of people sell a property because they're building a home, they're going to get rid of their current home. And so it's just as allows that rate to be more attractive. One, the market's better, market's a little bit lower. And two, when you have more equity in the property, you're going to be able to get a lower rate. And three is a lot of people do get more equity. They might do a shorter term, like a 15-year or 20. And those rates today are like closer to 5.5 versus like 6%. So
well,
I think
point,
that's
just
another
simple,
great point.
real simple, put it this way. You don't need to be concerned with what the rate is now because you've got a commitment and it costs you nothing to get it.
Exactly.
And now you can go out and get the best commitment that you can get when the house is finished. You're not going to get the best commitment up front and lock a rate for 12 months prior to construction.
Nobody's got that great a rate.
Right. So you got a guarantee at the end. You know you got a mortgage at the end. We do guarantee you a rate. It's just not that competitive. And then we're simply going to probably more than likely pay it off when the house is finished. But you got the time to do it when you want to because you have a mortgage at the end. Stay in there for 6 months, 3 months, 1 month, 2 years. Get the best rate. Shop where you want. Let us help you with that, and we'll get you to a much better place at a very low cost.
Yeah.
So the second thing that we do really, really well is, of course, we want to be able to do second homes. And, second homes are historically, especially in that conforming space, treated a little poorly when it comes to rate. So these, you've heard me mention since 2002, I beat this drum more than once in several of our podcasts and newsletters about how Fannie Mae changed the game in 2022 on rates for second homes. Well, these are portfolio lenders that we work with to fund these construction loans. And we've got a lender that will give us a very competitive second home mortgage product that really doesn't distinguish with the quote Fannie Mae conforming limit. Remember, the Fannie Mae conforming limit is, what is that number, Alex? You miss it, 832,500,
yeah,
I think.
It just was updated.
Yep.
I feel like I'm getting old enough where it changes so often, or feels like it changes so often. I just start losing track,
So it does change a lot, and it's gotten really big. But they don't even care about what the loan amount is, whether it's 100,000 or whether it's $1 million or whether it's $1.5 million. This program has the same rate no matter what, whether it's conforming and under the definition or whether it's $1.5 million loan amount. And we also use this program a lot for the four-wheel drive area, where loan amounts often really are under, $800,000. There's a lot of smaller construction projects in the four-wheel drive area that are $400,000, $500,000, $600,000, $700,000 that we're going to finance with this product and we're using now. There are lenders who just don't go to the four-wheel drive area at all, period. This is one of those where we can do that and offer it also an extremely competitive rate. So that's the second program. Anything you want to comment about that on, Alex?
Yeah, I think that we do have favorable loan amounts. I think a big part of building a house is trying to be prepared for the things that are about to come once the home is built, which is furniture, landscaping, a lot of times in our markets preparing for tenants, and having additional money outside of what you used for closing on the mortgage or to build the home is really important. And it's something that Drew and I feel like we're probably able to really kind of specialize or navigate that process of how to kind of lower the amount of money needed as much as possible anyways, to then have that kind of reserve for the future, right? Because personally, when I built my house a few years ago, I feel like I just spent so much money to get to where I am, and I'm only owned the home for 5 years. And after 5 years, I finally feel like I have the furniture, I have the landscaping, I have those items, and I know other people got to feel the same way, even if it's a real property.
It is that way. When you a new construction project, you don't really feel like you're finished with and got your house where you want it for 3 or 4 years. It
3
takes
or 4 years at least. So
especially when it's your primary residence, when you're treating it that way. It's a difference between a primary and a secondary home. But even with a second home, I bet you feel like, well, there's certain things I didn't get it right, or I didn't put I thought I under budgeted for furniture, or I wish I had done things this way. And it takes time to get these things done.
Yeah, for sure. So that's uh that's the second product. You want me to talk about the two-time close, or do you want to talk about
I mean, it's my newsletter, but you can talk about the two-time close.
I just think that the two-time close is the most, like, what I would say is that, if you walked onto a car lot and you said, what's the most expensive car? And I pointed to it, the same thing for the two-time close. It's like, that's the most expensive product. Don't get me wrong, it is a pricier way to have a home built, but at the same time, there's a lot of nuances to lending, and this is a way to get around some of those nuances. And especially when it comes to second home or kind of rental property that's kind of out of the box, that's not typical, income driven pay, that your income pays the payment. Typically it's the tenant that's paying the payment, or there's some type of subsidy there to where you're not carrying the full mortgage payment the whole time. There's just more creative ways to get things done where someone wouldn't have ever been able to build a second home, but because we have a two-time close, which, yes, it's more expensive, but we're able to provide really great solutions in our market that make sense. Our two-time close program is more expensive. I would refer to it as, in the newsletter, you'll see is it's referred to as hard money, which I'll get Drew to kind of explain a little bit more what hard money is. But compared to like what really typical private money, hard money individuals charge, our construction loan cost, even though, like I just said, it is the highest cost, but comparatively to others, it is very reasonable. And I've already had, I think, some really great success stories of where a client didn't check the box in a typical income fashion, and we're able to help them build a home. And it wasn't a high risk loan. It just made sense, and I do have to get the payoff on the final mortgage, which I'll let Drew talk about payoff, and I'll let Drew talk about cost a little bit of private money and what that really means.
Yeah, well, I'd just like to say before we move on to that is that the two-time closing program does have a real niche to fill. And I've never had both. I've always had either a one-time close program, which is what I did when I got into mortgage, because Bank of America developed one, which they no longer have, by the way. And then I did construction lending independently before that as a banker. Now I have both. I basically the same thing I had at Bank of America as a quote mortgage guy, or that I had at another bank that we recently worked for, Citizens Bank, a one-time closed construction perm program. But now I have this option. And those options at those banks were always primary and secondary homes only. You heard us talk about that on some of these programs already. That's what they are. This is not the two closing program is an investment program. It's a DSCR program potentially. It's anything that we can get approved. We can get a fund under that construction loan. And if you take the newsletter and read the newsletter, we give you an example, and I'll just briefly hit on it here, is an $800,000 house, for a person who makes $185,000 a year. It's possible for them to own as a primary residence, but it's very hard for them to own a primary residence and that as an investment property, because it can't be treated like a second home because they simply cannot qualify. But if they came to the beach and said, I want to buy an $800,000 house and use the rental income to offset the payment, then, or an $800,000 mortgage is what we're using in the PDF example, is they would qualify for it because we simply on existing homes say, hey, you buy this house, it rents for X, we'll offset the payment, and then we'll let you get the mortgage off for it. You just go get a 30-year fixed rate. But when there's not a house there, you got to build it. The mortgage companies are like, I'm not touching that. We've already talked about it. They don't like it. Now, you can believe they really don't like it when they know that you don't qualify without the rents from buying it. And this is where we use this program more than any place else. It's a qualified borrower with income documentation most of the time, but we're using the rental income the property is going to generate to offset the payment. I'd really encourage you to take a minute to read the PDF about debt ratios and the income on this $800,000 loan amount and the rental income and how we offset it. Talking numbers like that sometimes get it just jumbled up in our conversations, but if you read it, I think it's really good information. The last topic is the so-called true hard money, as it's titled in our PDF, and this means that it's not First Heritage Mortgage Company's money. It's just money, hard money that we are able to secure, and we've talked to First Heritage, and they're okay with us doing this because guess what? They get to make the mortgage at the end. We're just going to get an investor to give us money to help our builder, our borrower, our investor that wants to hold property in an LLC or whatever to do the construction loan. And it's not held, the loan is, not with First Heritage, and it's not with another investor we sell these loans to. It's just hard money that we are able to secure from sources that we are familiar with. And this is a little bit more expensive than the two fund close program because guess what? It's higher risk. When you have higher risk, you're going to pay a little bit of a higher fee. But nobody really wants to fund DSCR or bank statement loans,
asset utilization.
These type loan amounts are two types, and they're very hard to get. And again, most of these loans are temporary on the books. They're not very long. So the interest cost is really not that bad, $10, $15, $20,000 during the whole construction project.
During the build.
And then, but you do pay, probably a minimum fee of $10,000 to maybe upwards of $15,000 for these is a fee. But think about it. Realtors charge 5% on $1 million loan, and that's $50,000. If you have to pay 3% on this loan, it's $1 million. Yeah, that's a $30,000 fee or something like that. It's still a lot less than you would pay if you were selling it. So you got to understand that your lender in these hard money cases really is your partner and should be compensated more in line with that kind of concept in mind than is with the concept of what you would think a general bank would, because you just couldn't do it without them.
Yeah, basically. You wouldn't have a home built. Yeah, for sure.
Yeah, you couldn't do it. You couldn't make the money as an investor, or you couldn't make the money as a builder, as a spec. You could lots of reasons to consider this. We don't make this program very often, but we've got it.
Yeah.
And that's the key. And the more people know that we got it, the more we'll do of them, of course. I always like this. My philosophy is you live here, you love the Outer Banks, you need to serve the community that you live in. And our community is full of people that make money building houses, whether they're framers, electricians, plumbers, or contractors. And if I'm in the mortgage business and I'm not supporting that industry, I'm not doing my job. And so I feel like by doing this thing, we're really adding to our community and helping out the Outer Banks.
Yeah, I just want to highlight, we really went over 3 different products super quick. We don't really want to go longer than 30 minutes here, but it's like Drew said, it's the first time where he's been able to offer both products. And I just feel like it's worth highlighting that First Heritage, or the company we work with, they really, want to get involved on how to help people and, building a house. And that's why they're able to offer kind of these unique scenarios that are 2-time closes. And I just, want to echo that we're super excited to be here. I think the results we're having are great, and we're helping a lot of people. And we'd love it if you connected with us. If you have a real estate related question, mortgage question, please reach out to us. We got tons of resources for you. And I think we'll just talk to you next week. I think that's pretty much it.
Yep. Thanks a lot.